Meet Harry, the aspiring young trader with big dreams and an even bigger appetite for success. He envisioned a future where he makes the right trades, picks the right investments, and swims in a sea of money. In this future, he would buy the Rolls-Royce, buy his dream house at that exotic location, and accrue so much wealth that his children's children would never know what it is to lack anything. However, Harry's journey in the world of trading turned out to be far more challenging than he had anticipated. In 2020, he discovered the promising world of cryptocurrency, where technology was turning ordinary Joes into millionaires overnight. And if he was honest with himself, the tech wasn't really his interest. It was all about the money. So, he immersed himself in what he thought were market fundamentals, trends, charts, and learned about various trading strategies. But despite his efforts, his trades seemed to consistently go awry. It was one step forward and two steps back. Day after day, Harry struggled to understand the intricacies of the market. He would often succumb to his emotions, letting fear and greed guide his decisions. He would impulsively enter and exit positions based on hunches. His profits would soar to the moon one day, only to come crashing down like a meteor the next, which would often result in significant losses. As this was happening over and over again, doubt began to creep into his mind, and his confidence plummeted. With mounting losses, Harry found himself in a cycle of despair. He questioned his abilities, wondering if he was cut out for the trading world. And to make matters worse, he ended up blowing his trading bank. Harry was told that he needed to find something else to do with his life by those around him. He contemplated giving up and pursuing a different career path. However, deep down, a flicker of determination remained, urging him to persist. So, Harry ventured into the world of forex trading. Assuming that the market would be less volatile than the crypto market, he funded his account again, and very soon, his old friends, fear and greed, came back rearing their ugly heads. And very soon, he blew his trading account again. One day, in his despair, while meandering about on the internet, searching desperately for how to become a successful trader, Harry stumbled upon a trading psychology book called Trading in the Zone by Mark Douglas. Because the book came highly recommended, he was intrigued, and he delved into its pages, seeking guidance on how to overcome his inner demons. He learned about the importance of emotional discipline, risk management, and developing a resilient mindset. Inspired, Harry decided to embark on a journey of self-improvement, fund his trading account once again, and give it one more go. He began implementing the practical things he learned from the book. Things like strict risk management rules, defining his entry and exit strategies beforehand, detaching his emotions from his trades, and treating each decision as a calculated business move rather than an impulsive gamble. And as time went on, Harry's newfound discipline and knowledge started yielding positive results. He began to see a gradual improvement in his trading performance. Small wins became more frequent, and his losses were kept in check. With each successful trade, his confidence grew, and he started to believe in his abilities once again. Months turned into years, and Harry's persistence and dedication paid off. He developed a keen understanding of the market and honed his trading skills. He was transformed from a struggling trader to a seasoned professional who's consistently generating profits and building a reputation for his astute decision-making. How can a single book help him turn his initial struggles into a stepping stone toward a rewarding and fulfilling career as a trader? But before I continue, I would like to let you know that I am Harry. And if you're struggling with turning a profit with your trading, I want you to know that Trading in the Zone can change your trading story, as well as it changed mine. In this video, I will show you the 5 important takeaways from the book that transformed my mindset and made me a better trader. Mark Douglas argued in the book that many aspiring traders make the common mistake of focusing primarily on studying market behavior rather than understanding their own mindset and personal attributes. According to him, cultivating the right trading mindset involves recognizing and embracing 5 fundamental truths about the market. And now, let's explore what these fundamental truths are. Fundamental truth. Number 1. Anything can happen. Mark Douglas emphasizes that no matter how well a trader analyzes the market, there are always unexpected events, volatility, and unforeseen outcomes that can occur. This concept serves as a reminder that even the most thought-out trading strategies are subject to the inherent randomness and unpredictability of the market. Understanding that anything can happen helps us as traders develop a realistic perspective and avoid becoming overly confident or attached to a specific outcome. By acknowledging the potential for unexpected events, you as a trader can prepare mentally and emotionally to handle various market scenarios and make more informed decisions. In trading, it is common for traders to develop expectations or biases based on analysis or beliefs about the market. However, the reality is that the market can behave in unexpected ways, defying conventional wisdom or defying predictions. By recognizing that anything can happen, traders are encouraged to approach the market with an open mind and without rigid preconceptions. This mindset shift helps to avoid emotional attachment to specific outcomes and prevents a trader from making impulsive decisions based on unfounded expectations. It allows you to stay objective, follow your trading plan, and respond to market conditions as they unfold. In summary, the concept of anything can happen in trading emphasizes the need for flexibility, adaptability, and risk management. By embracing uncertainty and being open to all possibilities, you will navigate the market with a clearer and more objective mindset and tilt the odds in your favor for long-term success. Fundamental truth. Number 2. You do not need to know what will happen to earn money. In the book, Mark Douglas suggests that traders often become fixated on trying to predict market movements accurately. However, he argues that this mindset is not necessary for profitability. Instead, he emphasizes the importance of understanding and managing risk. According to Douglas, successful trading is not about knowing the future with certainty. It is about having a structured approach that accounts for various possible outcomes and effectively managing risk and capital. By focusing on risk management, traders can establish proper position sizing, set stop-loss orders, and employ risk-reward ratios that ensure they protect their capital in case of adverse market movements. This approach allows traders to control their downside and limit potential losses. In essence, the statement suggests that rather than obsessing over predicting the future, traders should focus on managing risk, capitalizing on their edge, and consistently executing their trading plan. By doing so, traders can achieve profitability over the long term, even without knowing the precise direction of the market. Fundamental truth. Number 3. The distribution of winning and losing trades is random. This concept challenges the common belief that trading outcomes follow a predictable pattern or sequence. Mark Douglas highlights that in trading, the distribution of winning and losing trades does not follow a linear or predictable pattern, and this is a fact. This simply means that even a well-designed trading strategy will experience a mix of winning and losing trades that occur in an unpredictable manner. Understanding this randomness is crucial because it helps traders avoid falling into the trap of expecting consistent wins or losses based on past results. Each trade is an independent event and is not influenced by previous trades. Therefore, traders should not assume that a winning streak will continue indefinitely or that a series of losses indicates a string of future losses. By recognizing the random distribution of trading outcomes, traders can adopt a more objective and disciplined approach, avoid getting emotionally attached to specific trades or outcomes, and instead focus on executing their trading plan consistently. This mindset helps to mitigate the impact of any individual trade and enables traders to make decisions based on the probabilities and risk-reward ratios defined by their strategy. In summary, recognizing the random distribution of winning and losing trades reinforces the need for disciplined execution, risk management, and an objective mindset in trading. Fundamental truth. Number 4. An edge means only a higher probability of a winning trade compared to a losing one. One of the most important lessons I picked from the Trading in the Zone book is that having an edge in trading does not guarantee a 100% success rate or predict the outcome of individual trades. Rather, this is a trader simply having a statistical or systematic advantage that provides a higher probability of winning trades compared to losing ones over the long term. Having an edge means that, based on a trader's strategy, analysis, or unique understanding of the market, they have identified factors or conditions that give them an increased likelihood of profitable trades. This edge could be derived from various sources, such as technical indicators, fundamental analysis, or a deep understanding of market patterns and price actions. However, it is important to note that having an edge does not imply not being capable of being wrong. Traders will still experience losing trades despite having an overall higher probability of winning. The edge simply provides an advantage that, over a series of trades, can lead to consistent profitability. Understanding and recognizing one's edge is essential for traders. It allows them to have confidence in their approach, stick to their trading plan, and avoid getting swayed by short-term outcomes. Traders with an edge focus on consistently executing their strategy, managing risk, and maintaining discipline in their decision-making. By acknowledging that an edge is about probabilities rather than certainties, traders can set realistic expectations, embrace the ups and downs of trading, and make informed decisions based on their advantage. This should serve as a reminder that the goal is not to win every trade, but to capitalize on the higher probability of success provided by their edge over the long run. Fundamental truth. Number 5. Every instance of the market is unique. The last fundamental truth from Trading in the Zone simply emphasizes the idea that each moment in the market is distinct and should be treated as such. It highlights the notion that market conditions, price movements, and participant behavior are constantly evolving and cannot be exactly replicated. Mark Douglas stresses that traders should avoid making assumptions based solely on historical patterns or previous market behavior. Even if there are similarities to past situations, it is crucial to approach each trade with fresh eyes and analyze the current context. By recognizing the uniqueness of each market instance, traders are encouraged to remain adaptable and open-minded. They understand that relying solely on past experiences or generalizations can lead to faulty assumptions and inaccurate predictions. Traders who embrace the concept of market uniqueness approach their analysis with a focus on the present moment. They consider current market dynamics, fundamental factors, and technical indicators to assess the current state of the market. This approach enables them to make more informed decisions that are aligned with the specific conditions at hand. I will strongly encourage you to read Trading in the Zone by Mark Douglas if you want to transform your trading mindset and psychology. You can find a link to the book in the description of this video. And if you're further interested in learning the intricacies and the practical tips you can execute to improve your trading psychology, then check out this video up here where I explain how to improve your trading psychology. If you made it to the end of this video, I appreciate you. If you found this video helpful at all, please destroy that like button, subscribe to the channel, and turn on the notification bell so you don't miss it when I drop videos like this in the future. Thanks for watching.